What's up, YouTube? In this video, I want to talk with you about how to get financially independent using this study from the 90s. So, this study is publicly known as the Trinity study, and the reason is why because the three researchers are from the Trinity University from the US. The study was originally done in 98 and repeated quite a few times, or updated, must I say. This version is from 99, and they also did it again in 2011. And what they basically researched was what is a sustainable withdrawal rate from your retirement portfolio. So let's say you want to retire, you have 10, 15, 20, 30 years ahead of you, and you need to have a certain amount of assets, amount of net worth, and what is a sustainable withdrawal rate? Like how much percent of your portfolio can you withdraw every year without it ever like going down or going below zero, while investing in a combination of stocks and bonds. Um, and this is what they researched, and they had quite a few results. I will show you them here. In table 1, we see the results without inflation, and in table 2, it's adjusted for inflation. Of course, over time, inflation will reduce your spending power. So if you spend $1,000 a month and you buy exactly the same stuff, same groceries, same everything, in 20 years you won't be able to buy the same stuff. Okay, so this is the first table, and you see they have some information here. Here you see the payout period. This is either 20, 25, or 30 years. Then you see the comparison of stocks and bonds. This one is 75% stocks, 25% bonds. And they use only 25% increments, by the way. Then we're going down to 50, 50, 25, 75, and 100% in bonds. Time is always the same. And here you say, hey, if the withdrawal rate is 3%, how high is the chance that you will make it? Percent of all past payout periods supported by the portfolio. So you see in the first case with 3%, it's 100%, all cases. And this research was done from a period from 1926 until 1997 or 79. Then you see if you go up and up and up, the chance obviously goes down from 100 until 29, 33, when you take 12% of your whole portfolio a year. You see chances going down when you invest only in bonds, obviously because the long-term results of bonds are lower than of stocks. Here you see table 2. This is with inflation adjusted. Again, 1926 until 1997. 100% in stocks, 25, 20, 25, 30 years. And then you see how high the chance is that you'll make it. 3%, 100%, 4%, almost 100%. And the 4% rule is a very famous rule. It's basically, it originated from this study, from the Trinity study. The 4% rule, that if you take 4% for your portfolio a year, that you can sustain yourself for 20, 25, 30, maybe even longer, maybe even for life. Because people who want to be financially independent, obviously, or usually fall back into this or to this theory, to this rule of thumb, the 4% rule. Then authors did the same thing, but then from a different time period. This one is from 1946 until 1997. This is to leave out some bad periods in history for stocks, like the Great Depression and bad crises in the US, to see if it makes a difference. It makes some difference. The results are slightly higher than the last one, but obviously, the higher your withdrawal rate, the lower your chance of succeeding. This one is adjusted for inflation. Same goes here. If you withdraw 12%, then your chances slim down very fast. So, what is their conclusion? They concluded investors who expect long payout periods should choose an asset allocation at least 50% common stock and a lower withdrawal rate, as we saw when you use more bonds than stocks or choose a higher withdrawal rate, the chance of succeeding goes down. So higher withdrawal rate appears to be sustainable for shorter payout periods, such as 15 to 20 years, provided portfolio has substantial percentage of stocks. So this only works a higher withdrawal rate if you use a small period of time. When you choose larger periods of time, it doesn't work anymore. Investors who plan to inflation adjust withdrawals should choose lower withdrawal rates and invest at least 50% of portfolio in stocks. And finally, the lower withdrawal rates of 3% and 4% recommended by some analysts appear to be excessively conservative for portfolios with at least 50% stock, unless investor wishes to leave a substantial portion of the initial retirement portfolio to his or her heirs. As I said, when you increase all the way to 12%, your chances slim down very big. But we see in a lot of cases 5%, 6%, even 7%, sometimes even 8 is is doable. You still have a relatively high chance of succeeding. Also in the adjusted for inflation table. Of course, like I said, this one is a little bit chances go down somewhat, but still 5%, 6%. Of course, the question is where what is for you an acceptable risk reward ratio. But still, if you choose 5% or 6%, it's 81 or 65% chance. Yeah, even 91 if you just choose 20 years, or 77% chance. So this is a very famous and very important study done. This one is the update from 99, and the authors, the original authors, like updated it quite a few times. And the last one was from 2011. And why did they do that? Because they got a lot of like critics, and they wanted to use different data. They wanted to update the data, and in this version, they chose the data from January 26 until December 2009. Um, because of course you can say, hey, what worked in history, what worked in the past. There's no guarantee it will work it will work in the future also. So that's why they chose different time periods, or must I say they updated it. And what was the conclusion from this part? We conclude that 75% success is where to draw the line on portfolio success rate. A client can plan to withdraw a fixed amount of 7% on initial value of portfolios composed of at least 50% large company common stocks. So what does this mean? The title was Portfolio Success Rates, Where to Draw the Line. The critics of other researchers was like, hey, if you choose a higher withdrawal rate, of course your chance of succeeding goes down. And where do we need to draw the line? What is still acceptable here? And others here say, okay, it's of course subjective, but we say 75% success rate is where we draw the line for portfolio success. Then you can see if you use portfolio of at least 50 different stocks, that even a 7% withdrawal rate is deemed okay. And the sample data suggests that clients who plan to make annual inflation adjustment to withdrawals should plan to lower initial withdrawal rates in the 4% to 5% range, again from portfolios of 50% or more large company common stocks in order to accumulate future increases in withdrawals. So if you want to adjust for inflation, you should lower this a little bit more to 4 or 5%, because your total withdrawal will of course be more because you have to adjust for inflation. And here we can see the tables as well. They highlighted everything above 75% with this black markers. This is what they deem as acceptable. And you see 100% stocks. Even 8% is acceptable for 30 years because it scores 76%. And if you look to the second table, this one is adjusted for inflation. You can see that with 100% stocks, even 7% is okay for, for 25 years, and 5% is for 30 years. And if, of course, you accept a little lower chance of succeeding, then you can still do 7 or 8%, but of course, your chances drop. But it's still looking pretty good. Okay, after seeing all these tables and seeing these conclusions, the question, if you didn't already know, is of course, why is this important for me? I'm not going to retire yet. I'm maybe very young. Um, but this one is, of course, this study is very famous within the FIRE community, the people who want to retire early and want to be financially independent. And why is that? because people are saying that you can use this for a period up to 30 years, so more than 30 years, maybe 40, 50, or maybe indefinitely. And there was a person online who was experimenting a little bit with codes to see what the results would be with the Trinity study if you would use it for 50 years. And this is from a time period of 1871 until 2024. It's on the website of PoorSwiss.com. And then you see the index, US bonds, stocks, and this is the data. And if you use the red line, 100% US stocks, then you see that between 3.4 and 3.6, withdrawal rate still has a 100% success rate for a period of 50 years, which is remarkable. If you go down a little bit, 4% or 4.5, it's still above 70%, still around 75%. So that gives a high, yeah, chance that even if you don't use this to retire but use this to live off indefinitely, that it might be working. Okay, now to the more serious, serious interesting part, because we want to know this because we want to be financially independent. Therefore, we're going to use this rule, and I made some calculations which I'm going to show you in a few seconds. So first, a quick recap. This is called also the 4% rule. And why is this? Because you can simply calculate or estimate your desired monthly income. How does this work? You can multiply this number times 12 for a year has 12 months. And this outcome is your annual salary or the 4%, or 5, 6, 7, which number you use. And then you multiply this number times 25 to know your needed net worth and assets. Because 4 times 25 equals 100. And of course, this number will change as you change the withdrawal rate as to 5, 6, 7%. And this number 25 will, of course, change as well. Okay, it's time to show you some examples. Because the next question is, of course, how much money do I need? Let's say you want to do this, you want to be financially independent, and you want to know how much money do I need to make this work. Of course, this depends on your monthly spendings. Let's say an example, you spend $2,000 or €2,000 a month, and you want to have a withdrawal rate of 4%. You just calculate it times 12, 24,000, 24,000 times 25, and then this equals 600,000. So this means if you want to live off €2,000 a month, you need to have a net worth of at least 600,000. If you choose a higher withdrawal rate, let's say you want to have some higher net income, then of course this changes. Then you can use €2,500, 3,001, or even 3,500, still with the same amount. But of course, your risk goes up because you have to choose a higher withdrawal rate, 5, 6, 7%. Of course, this is still deemed as acceptable by under some conditions by the others. So you have to really weigh the risk reward ratio for yourself to see, does this fit me, and is this okay for me? Another possibility, of course, is using less assets. Let's say you want to be financially independent, but you don't have 600k. You can use this principle by using less assets. So how would that work? Let's say you still want to still want to gain €2,000 a month as your monthly income. Then you can do this and multiply this times 12 equals 24,000. And then you use this multiplier times 20. Why 20? Because 5 is 1/20th part of 100. And then you go get to this number, €480,000. Let's say you still don't have €480,000. In another example, you can use a withdrawal rate of 6%, and that equals 399,840. So even less than 400,000. And in my last example I took, you could say, hey, I want a withdrawal rate of 7%, which is higher, which makes the risks higher, but even though 7% is still deemed as acceptable by the researchers in some circumstances. And that equals even less than 400k, less than 350k, but it equals 342k. So of course, if you don't have 600k, this is another good option for you. Of course, you can always use a lower net worth, lower amount of assets if you're willing to take more risk and up Withdrawal rate in this video I didn't calculate that yet because I don't think that it's really like realistic for people who really want to be fire and want to use this for a longer period of times, even maybe longer than 30 years. Let me know in the comments down below if you want me to make another video with updates with 8, 9, 10, 11, 12%, or even higher. If you're willing to take more risks, let me know down in the comments below what you think of this video. Was it helpful in any way? Please like and subscribe. Turn on the bell icon for notifications, and I catch you in the next video.